As investors, when we think about investing and making money, we think about the best opportunities that we have as individuals to get the best return that we can. And that depends where we go to invest and how much we make on our investments depends on many things. The first and foremost is our goals. What is it that we're trying to achieve? So first of all, understanding where you are financially and where you're going is the most important thing as you're looking for investment opportunities. The second thing that you want to think about is what is my current financial situations and what are my risks in looking at a certain kind of an investment. Can I afford to, any investment is risky. So you need to understand the risks of investments and whether that's the right opportunity for you to go into a certain investment. And the third thing you need to consider is your knowledge, expertise, and ability to identify those good opportunities and see whether an opportunity is good, really good, or it's another shiny object that in the end will cost you quite a bit of money. So as a financial planner, those are the things that come to mind when I talk about investments and some of the more complicated and complex types of investments. I am not the only one who thinks about safety and security and positioning investors for their best chances of success. The government has actually thought about it as well in terms of what are the safeguards that they can put in place to make sure that people do not invest in the wrong things and expose them to unnecessary risk. The Securities and Exchange Commission has come up with certain rules that define the type of an investor that a person can be. And depending on the type of an investor, what kind of opportunities are allowed them in the spectrum of investing. So there are three types of investors that a person can be. The first basic one is the non-accredited investor. The second one is a sophisticated investor. And the third one is actually an accredited investor. What are these differences and why do they even exist? The government assumes that there is a mark of sophistication and intelligence, well, not intelligence, but actually knowledge that every person possesses. And the more financial resources they have, there is a relationship between the resources and the knowledge of finances and how much risk you can take. So at the very basic level, non-accredited investors are individuals and families that have maybe on the income on the lower side, not enough in net worth, and are not actively and proactively investing in growing their investment portfolio. At the second level from the non-accredited investor is the sophisticated investor. And sophisticated investors are more financially savvy, and have more financial security and pay more attention to their finances. So they're growing their net worth and they're growing their investments, but their security and their wealth is not to a point where they can qualify as accredited investors. At the top of the food chain, so to speak, as it comes to investments, is when you qualify for being an accredited investor. What an accredited, basically, what is it? The way that the government can look and see, okay, is this person accredited or not? The easiest and most straightforward way is to look at A, how much they're making, and B, what they have in assets, how much wealth they have. So the most current definition of an accredited investor is an individual who makes $200,000 plus a year in income, or a couple that makes over $300,000 in annual income. Or this individual or a couple have net worth that is $1 million and above, excluding your primary residence. So this net worth can be an investment property. It can be investments in the stock market, in a brokerage account, or even a retirement account, but it does not count your house. So once you add up your resources, and again, if not including your house, if you have over $1 million in your net worth, then you can qualify as an accredited investor. So how do you decide if you're an accredited investor, and how do you prove it? there are a couple of ways to do this. So you can ask your CPA to actually vouch for you, and they can provide a letter that you're an accredited investor. So that seems to be the way that I have identified that is a way to do it. Or if you're not, so that accredited investor in some ways is actual. You can look at your tax return and say, okay, did I make $100,000, $200,000, or $300,000 or more, or do I have net worth of $1 million or more? So when it becomes a little more interesting, it is understanding who is a sophisticated investor. Since there are no financial requirements as to their income or net worth, how do you determine if somebody is a sophisticated investor? It seems to me that the way to do it is when this sophisticated investor wants to invest in something, they actually have to have a relationship and a conversation and a discussion with the entity or the person who is offering an investment that they're interested in. And through conversations, discussions, questions, and back and forth, the sponsor of the investment can figure out whether this can decide and determine whether somebody is a sophisticated investor or not. And same, it's even less well defined and more ambiguous on the side of the non-accredited investor. So why is this important to know what kind of an investor you are? Because typically the reason you would be interested in something like this would be to go after, to invest in a certain amount, certain asset, certain opportunity that requires an accredited or sophisticated designation. And this is where there is another concept that I want to touch on, and it is the public securities and non-public securities, and how the Securities and Exchange Commission defines ways that private entities, companies can offer investment opportunities to the public. Most of us are very familiar with the stock market and in the process of initial public offerings. Anytime that an entity or a business wants to bring an investment to the public, they have registration requirements. They have to gather certain information and make it available to the general public under certain rules, regulations, and under certain compliance requirements. But the SEC understands that not all entities are big enough or strong enough or have enough resources to offer investments to the general public. So there are more limited, narrow investments that can be offered to investors under certain conditions. And there is something called the Regulation D, which is basically defines exemptions from the registration requirements of public securities. And of course, after every regulation, there are certain rules that define what exactly is this rule supposed to do for you and how you apply this rule in your own particular situation. So we are going to talk. So a lot of times, what sparked my interest is this understanding, is this feeling that many realtors and want to invest in real estate syndications, where these rules apply very strictly because most syndications are private offerings and they fall under the Regulation D. And so if you're an investor and you're looking at a syndication to understand whether you qualify or not and whether you can do it or not, so there are two rules. There is one rule, I think it's 506B and C, that defines under 506B that a sponsor can offer an offering to an unlimited number of accredited investors, but up to 35 sophisticated investors. And then there is another rule, I think it's the 506C, when it says that this investment is only open to accredited investors. And there is an unlimited number of accredited investors who can participate in this deal. In every private placement or every private offering, there is a sponsor who is actually offering and marketing this opportunity, and he or she has to look at the universe of investors around them to understand, hey, who can invest in my opportunity? How do I make sure that I take on the right investors so that A, I achieve my goals, B, they achieve their goals, and C, I don't expose myself to unnecessary risk, and also to troubles down the road with regulators, with the deals going south, or with these investors not being the right ones for the deal. So typically, the way the syndications are structured, there is a general partner who sponsor. For example, if you're buying a property and it's a multifamily property, the sponsor will plan on taking a loan from a bank to finance part of the mortgage, but about 25 and 30% of the down payment that needs to be collected before the bank can invest in this deal, can lend the money to this, say, big multifamily or an apartment property. There needs to be a down payment that if the general partner does not have enough funds, they will go and fundraise from other investors, and the general partners want to have accredited investors, or at least sophisticated investors who they know will be able to tolerate the risk and the time that it takes to get the return, and also the uncertainty around a certain project. So there is the general partner, and then there is the investors in this deal are considered limited partners. And there are, of course, many rules about limited partnerships that we can talk about in another Facebook Live. But basically, the limited partners are the investors who invest, and they basically put their trust in the general partner who will manage the property and provide the returns to limited partners for really doing not a ton of work, but providing the capital and expecting passive income. So it comes to, if you're somebody who's considering syndication or investing in a big project like that, you've got to be aware of a lot of things and do your due diligence process, understand who you are, what is right for you, and whether it's a good opportunity for you to pursue. These are excellent ways to build financial security, to build wealth. Well, I would say that these are really just more advanced wealth building opportunities that you should be only thinking about pursuing when you have reached basic financial security and you have things in place that will ensure your retirement income, ensure your safety, your security, and the certainty that you will not run out of money when you are at your vulnerable age of 80 and 85 years old. What I see quite a bit in my work is this desire to leapfrog the basic financial security and sort of take shortcuts. Hey, here I am, I'm going to invest in syndications and I'm going to build wealth. Having talked to dozens of individuals and families and having seen their situation, what I would recommend is focus on basic financial security first. Take care of your money in the right way. Build your house from the bottom up so that it's solid, it's secure, it's on a solid foundation, and it will stand the test of time and the test of unpredictability of our lives. This is my mission, to make sure that women successful realtors who make quite a bit of money also see the results of their income and their work in their financial security, so that at the end of your life, you're looking at your retirement income, you know exactly where it's coming from, and you're not relying ultimately on Social Security to provide for your needs in old age. So I thought this was a helpful overview. I know it was a very high level and general overview, just to get you thinking about what kind of an investor you are and what you would be investing. But please take a step back and understand where you are financially and what is your best next move. And I would recommend you talk to somebody who can understand where you are and can provide the best guidance in terms of that next move, so that you can take the next move, position yourself for higher and higher financial security as you go forward. I am here on Facebook. Please reach out. And if you have any questions or comments, let me know. I'm happy to either answer them here online or address them in a future Facebook Live session. Have a great Friday, everyone, and I will see you next week.